We've been discussing the various steps involved with auditing the revenue and collection cycle. In the last video, we discussed the first step, understanding the various activities that make up a company's revenue and collection cycle. The next step is to identify any significant accounts and relevant assertions. An account is significant if there's a reasonable chance it could contain a material misstatement. So how do auditors identify significant accounts? They can use the audit risk model as follows. Set audit risk at a level with which the auditor is comfortable, usually low. Then assess the risk of material misstatement, both inherent risk and control risk. Now you can set detection risk at the appropriate level for the account in question. Certain accounts will be at a higher risk of material misstatement, so the auditor needs to focus the most attention on those accounts. For example, there's always presumed to be a fraud risk for revenue recognition, so sales revenue will always be treated as a significant account. Accounts receivable will usually be a significant account as well, with limited exceptions. For example, a company that has a small, immaterial accounts receivable balance. After identifying the significant accounts, such as sales revenue and accounts receivable, the auditor should identify the relevant assertions being made by the company's management. Now, what does it mean that an assertion is relevant? It means there's a reasonable chance the management assertion could contain a misstatement that leads to the financial statements being materially misstated. For example, occurrence is a relevant assertion when it comes to sales revenue. Management is asserting that a sale took place, but management also has an incentive to lie about that. Here are some assertions that management is making about revenue transactions, along with some misstatements that could occur. We'll discuss each one. Let's start with occurrence. Management might tell you the company had $100 million in sales last year, but did those sales really occur? Maybe the company hasn't even shipped the goods, or the customer never even ordered the product. Management usually has an incentive to overstate sales, so occurrence is definitely a relevant assertion. Next, let's look at completeness. Management is asserting that all revenue transactions have been recorded. This assertion is less important than occurrence, as management typically has an incentive to overstate, not understate, sales. But mistakes happen, and it's possible the company didn't record all the sales that it should have. The authorization and accuracy assertions are also important. Were the goods shipped at authorized prices, and was the correct amount of revenue recorded? The cutoff assertion has to do with timing. If the company had a bad year, management has an incentive to hold the fiscal year open longer to include some of next year's sales in this year's results. Finally, there's classification. Were the revenues properly classified? Maybe management categorized some non-operating revenue as operating revenue to inflate the company's operating income. You've almost made it to the end of the video. Stay strong! Now let's discuss some assertions that management is making about accounts receivable balances, along with some misstatements that could occur. We'll start with existence. The company might claim it has $80 million of accounts receivable, but do these receivables really exist? Management is asserting that they do, but these receivables could be from fictitious sales. Management is also asserting that it owns the right to those receivables. But what if they sold the receivables to another company and didn't tell the auditor? Now, the completeness assertion says that all receivables have been recorded. This is less important than existence and rights and obligations because management usually doesn't want to understate receivables. But mistakes happen, so it's possible some receivables weren't recorded. Finally, management is asserting that receivables were recorded for the right amounts and for the correct accounts. Management is also asserting that it properly estimated the allowance for uncollectible accounts so that the net accounts receivable balance is correct. But what if they deliberately underestimated the amount of bad debt? That's all for now, my friends. I'm working on a guide that covers the concepts in this video, and I'll post a link in the description section below when it's ready.